Hello everyone, thanks again watching the AF3111 Intermediate Accounting 2 Week 6 topics. Now we're going to spend 2 weeks on the topic of income tax, and this week is income tax 1. Before you start watching this video, make sure you get a hard copy of the Week 6 notes ready and have a pen and some rough papers to make your own notes. Okay, let's start it and look at the menu. And this week we would cover the basics of income tax, which would be divided into current tax and deferred tax. And then in the second week, which is week 7, we would then spend the rest of the time focus on deferred tax. Okay, so we will look at current tax and deferred tax. And for informations, before you start this topic, okay, remember that there is no need that you need to have a prior knowledge in Hong Kong tax framework. I was assuming that in fact none of you would have that knowledge, okay, so that it won't affect you at all in terms of accounting. Now we would just cover a little bit on the how to prepare the profit figures based on tax law, but not in great deal of length. Okay, the details in fact on how to calculate profit from a tax point of view will be covered in Hong Kong tax framework instead. Okay, the relevant standard is in fact Hong Kong AS12. And let's have some background information before we start looking at the accounting side of income tax then. Well, just like the other weeks of topics we have covered so far, as I've mentioned before, in fact, intermediate accounting 2 or financial reporting, this states will not be just based on the concepts of accounting. In fact, sometimes you may need to have a knowledge, okay, a background knowledge from finance, from tax as well. And this week, we would have to look at the relations between tax law as well as the Hong Kong FRS. Okay, to begin with, in Hong Kong, under Section 14 of the Inland Revenue Ordinance, IRO, individual persons, including corporations or partnerships, as defined in this ordinance, provided they have done or carry out any trade, professions or business in Hong Kong, and they are making profits, and those profits would then be chargeable to tax, right? That would then excluding profits arising from the sales of capital assets arising in or derived from Hong Kong. So basically, all profit generated from these corporations, okay, for us we will focus on company, would be subject to tax in Hong Kong, and with exceptions like the sales of capital assets, such as sales of shares of another company. Right, those profit will be exempted from the profits tax in Hong Kong. Right, so sometimes we simply use the term income tax to refer to profits tax defined in the tax law. So the two terms are interchangeably. Okay, so when we use the terms income tax and profits tax, in fact they are meaning the same thing. Now, Hong Kong FRS, Hong Kong Financial Reporting Standards, as well as the inland revenues, in fact they measure profits differently, okay, and the difference, okay, obviously were in terms of like the timing of recognizing those sales or expenses, as well as how to measure the profits. And so we're going to spend some time to look at it. Now let's compare the two profits. On the left-hand side, left-hand column, we have accounting profit, right? Accounting profit. And by now, you should know from FA or even from IA1, the revenue that you generated, no matter whether that were from the core business or for your subordinate business, we call that income, right? So revenue, other revenue, minus all the expenses from accounting point of view as well, then that will give you what we call a pre-tax accounting profit, or in short, profit before tax, PBT, profit before tax. And this profit would then be different from the taxable profit calculations based on Inland Revenue Department in Hong Kong. The assessable income may be different from the income that we have, or the allowable deductions may be different from the expenses that we recognize in the financial reports. Okay, remember, income and expenses, when we calculate them based on the accrual basis of accounting. However, tax laws have different rules or applications in terms of how to measure income to be assessed or deductions from the income to be allowed, so that they are different. So taxable profit is determined by Inland Revenue Ordinance (IRO), and it is in fact a legal concept based on the Hong Kong SAR's public policies and revenue needs. Its main objective is, of course, to collect money and generate revenue equitably. Okay, and they collect the money and use the money wisely, which is something outside the control of the Inland Revenue Department. But then they have to collect the revenue on a fair basis, in other words. Okay, now as we just know it, basically the profit before tax or pre-tax accounting profit as well as the taxable profit, they are unlikely to be the same. And the reasons that they are unlikely to be the same can be summarized in terms of two major differences. The first difference, we call that timing difference, and the second type major differences, we call that permanent differences. So let's begin with timing differences. Timing differences arises from income and expenses included in accounts in a financial statement in one period for accounting purpose, but in another period for tax purposes. So an item like revenue can be recognizing in accounting statements, accounting reports, or profit and loss in period, let's say in this case, in period 5, but then from tax point of view, it could be in fact considered to be an income in year 7. For instance, it could be recognizing from tax point of view at the date when you're receiving the money as compared to when you're recognizing the revenue. So they could be different. Because of that timing of differences here, the differences would then generate in one period, such as if you have a sales of 100 at TE5 and nothing for tax point of view, then 100 minus 0, then you have 100, of course, differences. And then in year 7, you have no revenue, but then from the tax point of view, you have a revenue. Then again, you would have a negative 100 here. Now, the 100 that you generated in year 5, of course, would carry forward. So that positive 100 you generated in year 5 would then be reversed by the differences that you have in year 7, and then they would offset each other. So it generates the differences in one period and then ultimately reverse in a later period. Now, do we have example? Of course, we do have some example. And basically, I would just give you two major categories of time differences. The first one is related to PPE, where the accounting depreciations may not be equal to tax depreciation in most of the cases. Tax depreciation in tax term, we call that depreciation allowances. Okay, but the two terms can be used interchangeably again in IA2. So for instance, from accounting point of view, usually we have straight lined, okay, accounting depreciation method, right? From tax laws, usually tax depreciation will be applying like a diminishing methods. So you would charge higher tax depreciation in the year of purchase and then gradually reducing. Okay, and also the fact that sometimes the magnitude may be different as well. Okay, and later on I will show you some example, particularly on PPE, okay, with a very big example to be followed on the coming slides. Now, before I turn to the coming slides, let's focus on the second example. Items which are taxed on cash basis, but which will be accounted for on accrual basis, such as prepaid rent, unearned revenue, etc. In fact, it would create a timing differences. So what does it mean here is accounting may be in recognizing an expenses or revenue in one period, but from tax law point of view, they would not be considered as expense or income until they were paid or received. Okay, let me just give you some example on that, right, so that it would be easy for you to follow. Okay, let's go to that example then. There we go. So let's look at the example then. To begin with, I'm going to look at prepaid rent. Now, I don't think you have any problem with the double entry for the prepaid rent, right? Because you've passed FA and IA1. Basically, what that means is you would first of all prepay the expenses that you're going to enjoy the services later on. Let's say at year end, you credit the bank 100 and prepaid rent 100. Remember, prepayment or prepaid rent is an asset. It's an asset, right? So therefore, from the accounting point of view, right, you don't have any expenses recognized in the year when you prepay the rent. So if you don't have any expenses, therefore, obviously there won't be any impact at all at the time at the year end for the prepayment of the rent, because only the rent expenses will be deducted from the accounting profit. We all know it. However, this is assuming that, like the description on the top, the item itself is taxed on cash basis. That means when we pay for it, it would be deducted from the taxable profit. So TP represents taxable profit, AP represents accounting profits. So you can now see, right, from the accounting point of view, accounting profit point of view, there is no impact for this double entry. But from the taxable profit point of view, the money that you pay, in fact, would be considered as a deduction or rent expenses from the taxable profit point of view, TP point of view. Now, okay, because of the way we're recording them, the timing as well, there is a difference between the two figures. So 0 minus negative 100 is in fact what? A positive 100. So in other words, you now create a differences of 100, okay? And that makes, of course, the accounting profit and the taxable profit different in that year and that year end. Now let's move on. Let's talk about what happened at the start of the next year end. So in the next year end, right, the prepaid rent now becomes a true rental expenses or rent expenses because you have enjoyed the services provided by the supplier. Okay, and we know it. This rent expenses would then affect the accounting profit. It in fact reduces it. So that is why we minus it. Okay, so it actually deducts the accounting profit. But from taxable profit point of view, there won't be any impact at all. Why? Because the item is taxed on cash basis. So at the time when you pay, which means at the year end of a previous one, you already subtract that from the taxable profit calculation. So you won't repeat that again. So notice that again you have a difference. The difference is in fact what? Negative 100 minus 0 is a negative 100. And don't forget that in fact you have created a timing differences at the year end, the previous year end. This differences it does not reverse yet, so it should have to be carried forward or brought forward from the previous year end. Okay, compare with what happened of this year of the reversal of the differences. Now at the end of the year, you no longer have any more timing differences. So to repeat it once again, remember the accounting profit at the year end, in the previous year end, should be higher than the taxable profit if other items are equal. But then, and at the start of the next year end, the accounting profit is in fact $100 less than the taxable profit if everything's equal, other things equal, such as the sales, revenue, and other things are equal, and the expenses are equal. So you can see that, right? In fact, you have originating at time differences in a year, and then in the coming year, you reverse it. And therefore, at the end, there won't be any timing differences. And that's how it works. And it would, because of those timing of recognitions of the items, it affects the taxable profit versus the accounting profit in that particular year when you are recognizing the item. So I'm going to give you another example. This time, we were looking at unearned revenue. Unearned revenue means you are now, in fact, the seller, right? But you receive money in advance from your customers. So you debit bank, credit unearned revenue. Okay, if this item is taxed on cash basis, that would means, in fact, there won't be any impact at all from accounting profit in the year when you were preparing this entry, because the unearned revenue is a liability, right? And therefore, there won't be any effect on the accounting profit. But from taxable profit point of view, because you have debit the bank and provided that item is taxed on cash basis, that $100 becomes your income. All right, and the difference between the two, 0 minus 100, is negative 100. So now you would create a timing differences of 100. Now notice that in this year, right, your accounting profit should be $100 less than the taxable profit, right? Of course, because you didn't recognize that $100 as a revenue in a year when you receive it. Okay, then in the start of the next year, the unearned revenue now becomes a revenue. So you credit the revenue, debit unearned revenue. Okay, so what would be the impact now from the accounting profit and the taxable profit point of view? Accounting profit, you would then have 100, right? But taxable profit, you won't have it. The reason is because the item is taxed on cash basis. Certainly at the previous year end, that $100 is part of the profit now. You are not going to have another profit figure to be chargeable for tax. So the difference, 100 minus 0 in this year, is obviously positive 100. And don't forget that the credit balances, if you like, the timing differences that you have generated at the previous year end, it would be brought forward or carried forward, right, from this year end to the start of next year end. This negative 100 timing differences would then be offset or reversed by the positive 100 timing differences of this year, and at the end there would be no more timing differences. Okay, so you can see what happened, right? Because of the different timing of the recognitions of that item in the accounting profit versus the taxable profit, it generates timing differences. And then subsequently, it doesn't have to be in the next year, it could be in the year, even after next year, they would then reverse. Okay, and eventually the timing differences would then becomes nothing. All right, so I hope that would help you to understand a bit more about the cases where the item itself that would be taxed on cash basis, but then from accounting point of view, they will be reported using accrued basis. Okay, let's go back to the slides. Okay, we are back again, and I've just showed you two examples of items which are taxed on cash basis but account for it using accrued basis. Now I'm going to focus more on the PP issues where accounting depreciation may be different from a tax one. Let's look at the example here. X Limited purchased a non-current asset, a PPE for instance, on 1st of January 2015 for 9,000. This asset is to be depreciated on a straight line basis over 3 years. So from accounting point of view, you use straight line, the useful life is 3 years. Tax depreciation, however, under this tax regime in the country of operations for 2015, 16 and 17 are 4,000, 3,000 and 2,000 respectively. 4 plus 3 plus 2 is in fact what? Exactly 9,000. Okay, so of course we're assuming that there won't be residual value in this case. And the accounting profit before tax. Accounting profit before tax, remember, means what? Profit before tax, PBT. For each of the years, 2015 to 2017, for the 3 years, they have the same number, 17,000 per year. Now, I in fact choose the same number to show you an effect later on. So this, I did it with purpose. It has to be the same for the 3 years. Okay, income tax rate is charged at 30%. 30%. Okay, let's look at the table here. Now, no matter whether you're looking at it from the accounting depreciation point of view or tax depreciation point of view, the starting value of that asset is the same, 9,000, both of them. Now, from accounting depreciation point of view, we know that there won't be residual value and we would use straight line basis over 3 years. So 9,000 divided by 3, 3,000 each year. At the end of a year, of course, at the end of the 3 years, the balancing figure of, you like, the carrying amount or net book value should be equal to 0. And then from taxable profit point of view, the tax depreciation for the first year would then be 4,000, second year 3,000, and third year 2,000. All right, now then let's observe what happened then. We know it basically. The total accounting depreciation, which means 3,000 times 3, 9,000, equal to total tax depreciation over the 3 years. 4 plus 3 plus 2, they are also equal to 9. Also, one more thing is, because of the magnitude of the depreciation difference, accounting depreciation 3,000 in the year 2015 versus the tax depreciation 4,000 in the year of 2015. If other things equal like sales expenses, they are equal, except that depreciation are different, then you can expect it then that the accounting profit in the year 2015 should be what? Higher than the tax depreciation by 1,000, and therefore it originating a timing differences of 1,000. All right. Next year accounting and the tax depreciation, they are exactly the same. They're exactly the same. So there won't be any more further timing differences generated. But remember, the 1,000s you have originating it in the year 2015, in fact, did not reverse. So it would carry forward to the end of 2016. Then in 2017, right, your accounting depreciation now is 1,000 more than the tax depreciation. What does it mean then? It means that accounting profit, if everything equals, should be 1,000 less than the taxable profit, and therefore it would generate at another timing differences, but this time with a positive effects, and that would means that the cumulative time differences that you have started with the year 2015 with 1,000, carry forward to 2016, and now in the year 2017 it would then be fully reversed, and therefore at the end of the third year you have no more timing differences, which makes sense. So you can see that timing differences would originating in 2015 and carry forward to 2016 and reversed in 2017. Okay, and obviously you can see that the company itself, X Limited, do not have to pay more tax overall 3 years. The tax figures should be the same, right? Because they have the same total tax depreciation, total accounting depreciation. It's just a matter of, because of the different magnitude assigned in each year, that may affect the taxable profit as well as the accounting profit. Of course, assuming that other things equal. Okay, now we're going to move on and see what happened now. And let's see if the profit before tax as assumed in the question is 17,000, right? What I want to do now is I want to work out the taxable profit for the 3 years. How do I do that then? Well, not difficult. Remember, the profit before tax figures 17,000 per each year for the 3 years, they were calculated after you have deducted that by the accounting depreciation. And to calculate taxable profit, of course, we would not use accounting depreciation. Instead, we use tax depreciation to be deducted from all the revenue and expenses figures. So the way to work out the taxable profit would then be simple, is by adding the accounting depreciation for the 3 years, and they have the same number, and then minus the tax depreciation, 4,000, 3,000, 2,000 respectively, according to the questions. So now taxable profit would then be 16,000 year 2015, 2016, 17,000 and 18,000 in the year 2017. Okay, now remember the tax rate is 30%, so we use 16,000 times 30% is 4,800. And we use 17,000 in the year 2016 times 30% is 5,100. And the final year 2017, 18,000 times 30%, 5,400 respectively. Now, what does it imply then? Well, think about that. If profit before tax is 17,000, and if we just simply use this number multiplied by 30%, technically speaking, the tax expenses should be what? 5,100. But now we have 4,800 to be payable to the Inland Revenue. So of course, it seems like we are saving $300 in the year 2015. Okay? And in the second year, 2016, because the accounting profit and the taxable profit, they are the same. So you expected that the tax payable figure will be similar to, or in fact exactly the same as your tax expenses to be reported in the accounting record. So 17,000 times 30%, 5,100. There is no tax saving or more tax spending in the 2016. And in the 2017, the taxable profit is 1,000 higher than the accounting profit. So take 18,000 times 30% is in fact 5,400. Obviously, we are paying more now. Okay, we have to pay more. In this case, how much more then? Well, if you were calculating tax based on profit before tax, the accounting profit times 30%, it should be 5,100. But now, in fact, you may have to pay 5,400. So in fact, you have to spend more, 300. Well, does it familiar to you? Of course. The reason is you notice that you may create a timing differences in the first year, right? Because they are different. And then it would carry forward. And finally, it will reverse. So the timing differences that you create in the first year, in fact, represents a tax saving of $300. It would carry forward, and then eventually in 2017, it would then reverse it. Okay, so that's how it works. And notice that the tax payable that you recognize would not be payable within the same year. Usually, it would be payable in the next 12 months. Right, related to the current periods. So if you recognize a tax payable today, then in fact the payable would be settled in the coming years, 12 months. Now, so you can see, to summarize it, basically because we have more tax depreciation as given by the Inland Revenue in the year 2015, 4,000 minus 3,000, 1,000 more for the tax, which means the company should pay less tax because of the higher tax depreciation, right? But as compared to the accounting one, so it would be in fact paying less tax. Okay, and then that tax would then be deferred, part of it, to the future year 2017, so that in the year 2017, when the tax depreciation is in fact 1,000 less than the accounting profit, so that would means what? That would means the taxable profit would now be 1,000 higher than the accounting one. So you would then have to pay more tax, and the figures is exactly the same magnitude of your tax saving in the year 2015. Okay, right. So let's look at what happened then. After we have worked out the current tax figures as determined previously, if we now subtract the current tax figures 4,800, 5,100, and 5,400 from our PBT figures 17,000, what do you see then is in fact the profit after tax will now be not the same, right, as compared to their PBT. So PAT is different from PBT, and they are not the same in the 3 years, even though that in fact they have the same profit before tax level over the 3 years, equal to 17,000. Well, what would you think if you are the users of a financial statement? You're looking at X Limited. What do you think about X Limited? You may then think, what, X Limited is in fact not doing well, right? Because their profit after tax are deteriorating over time. But that is not true, because they kept maintaining the same profit before tax over the 3 years. So by doing this way, in fact, it would be providing misleading information to the users of the financial statements. So users of the financial statements, such as shareholders, might be misled by the above profit figures and thinking about that the company's performance is in fact deteriorating. In fact, this is not true, because they earn the same profit before tax level throughout the 3 years period. Okay, because of that reasons, we must do something about that, right? In order to restore the situations to in fact providing a good picture for the shareholders to look at the profit positions or performance of the company. So Hong Kong AS12, the income tax standard, believes that tax not paid in 2015, which means that saving should be accrued for it first and then provided in 2015, which would then be consistent with the matching concepts, even though tax payment would then be deferred to 2017. So what do we mean by that is the standard believes that we must increase the tax expenses by 300. Even though we have tax saving in that year, so we have to do a double entry for it. And then in the year 2017, we have to reduce the tax expenses by 300. Okay, and so that we would have the same profit level over the 3 years. Okay, so this is what we call accounting for the future tax or deferred tax. The whole idea is to restore the relationship that should exist between accounting profit which is profit before tax, and the tax charge. So remember back in FA, right? If you know what is the profit before tax figure, you simply multiply by the tax rate. That should be your total tax expenses of that year. But if we were preparing or working out the taxable profit multiplied by tax rate and then recognizing the tax expenses based on the inland revenue tax law, then you can see the impact. Then we may have a misleading results. So because of that reasons, we have to do something about that. So as I said in the previous slides, if we calculating current tax based on tax laws, which is the three figures you can see here, then from accounting point of view, we must then adjust and providing a deferred tax entry. In a year when we have tax saving, we add back 300. In a year when we have more tax spending, then we have to subtract. Okay, and at the end, can you see it? The total tax expenses should be the same, which is effectively equal to profit before tax multiplied by tax rate. So how do we did that then? We do that by taking a debit more expenses in the year of 2015 by debiting tax expenses 300, and then we credit the tax expenses, which is like this, minus the 300 in the year of 2017 to the statements of profit and loss, adjusting the tax expenses figures. And then the deferred tax expenses, which is this row here, would then interact with the current tax expenses, which is this row here, to give an overall figures that is equal to profit before tax multiplied by the 30% tax rate. Alright, so at the end, it would give us a more realistic picture, which means profit before tax minus total tax figures equal to profit after tax, and they should be equal 11,900 over the 3 years period, the same figures overall. So that gives us a more realistic picture of the company's performance. Okay, right, so far we know the concept here. But what do we do in terms of the name of the accounts that we debit in the year of 2015 or the account that we're going to credit on the 2017? Okay, in order to match the tax expenses with the accounting profit. Okay, which account under the statement of financial position, right, should we credit? Now remember, if we debit the tax expenses of 300, then in order to balance debits and credit, we must then credit another account within the 2015, right? And what's the name of that account? And same thing happened here. If we credit tax expenses by 300, then which account should we debit? What's the name of it? Okay, to give you a better picture, so I'm going to show you an additional slides which then give you the overall picture of the double entry for both the current tax and deferred tax. Let's take a look at that slides. Yes, that's the slides. Now what we're going to do now is I'm going to show you the entry for current and deferred tax. Let's show the current tax. It's easy. For the current tax, all you have to do is after you work out the taxable profit, you multiply by tax rate, you have these three numbers. So you would then debit tax expenses 4,800 and credit current tax liability with the same amount. And you would do that for the year 2016 and 17 as well. Okay, that's current tax. And remember, the way to calculate these figures is based on taxable profit, right, multiplied by tax rate. And taxable profit calculation is different from the accounting one, which I will give you more illustration after this, at least during this week. For the deferred, remember, we must add back 300 tax expenses by debiting it, and then the other side of the credit, the name of the entry account, we call it deferred tax liability. Deferred tax liability. So that means it will be settled in the future years. It doesn't have to be in the subsequent year 2016. It could be longer, such as in this case in the year 2017. Okay, so in the year 2016, there won't be any deferred tax entry at all because we don't need to put through that adjustment. But then in the year 2017, as you can see, the tax expenses should be reduced, so we credit it. And then on the other hand, the debit side, we would then debit deferred tax liability. Why we debit deferred tax liability? Remember, we create a time differences first, then we reverse it. So at the end of the 2017, no more deferred tax liability balances exist. And that's how we did it. in a simple manner. So far, the way I suggested in here is just a quick illustration on how to prepare the tax expenses from current tax point of view as well as defer, right? But the actual way of doing this would not be as simple as the current method, which I will talk about that later on, okay? Because under Hong Kong AS 12, the way to approach this method to determine the deferred tax would not be as simple as the current approach suggested in here. Okay, let's cover that a little bit more later on. Okay, so no worry. Let's go back to the slides then. Okay, let's turn to the slide 13. Remember, there were two major differences that makes the accounting profit different from the taxable profits. We've just studied the timing differences. Then we have the permanent differences coming up. This one is, relatively speaking, easy. The concepts are simple. It means that income and expenses items that arise, which are included in the accounting profit calculation, but are permanently disallowed or excluded from the computations of the taxable profits. So for instance, if you look at the diagram at the bottom, we may have some revenues or expenses that we recognize in the accounting profit in the year 5, but from tax law, they will never have any impact on taxable profit, permanently disallowed or excluded from the computations of the taxable profits. So we call that PD. PD mainly arise because under the Hong Kong tax law, certain types of income are in fact tax-free, or certain types of expenditure are in fact disallowed for tax. Now, because this is in fact not a Hong Kong tax framework, so I do not expect you to know all the items that would be income tax-free or that expenses are disallowed. Instead, I will give you a couple of examples here that you may need to know. Okay, or in fact the question would clearly stated that they are in fact tax-free or disallowed for tax. Now notice that, right, with the permanent differences, they would have no future or current impact on the amount of tax calculations an entity would pay in the future periods. So such as the example I've illustrated there, you may have a profit or sales or expenses recognized in year 5 from accounting point of view, but from tax point of view, they would never be considered as income. Maybe they're tax-free or they're disallowed for tax. Okay, and the following items are just some example. For instance, fines and penalties obviously are considered a settlement, a payment. So we would have it in our accounting profit as a deduction expenses, right? But from tax law point of view, they are not supposed to be a deductible expenses. Or donation made it to unapproved charities. They are expenses from accounting profit point of view, but not for tax. And non-business entertainment expenses, they are expenses from accounting profit but not for tax. And dividend income, they are in fact income from accounting profit but not for taxable profit income. Okay, so there are some of the examples you need to know. Okay, let's take a break.